Now, let's turn to the business of moving capital and money essentially around the continent. Countries around the world are unlikely to meet the G20 targets to make cross-border payments easier and faster to execute by 2027. That's according to a paper from the Bank for International Settlements. All the way back in 2020, the G20 agreed to a range of targets that they aimed to hit by 2027. Now, these included lowering the cost of remittances to a global average of no more than 3% to send $200 and to have no payment corridors with costs over 5%. They also included having 75% of transactions credited within 1 hour and the remainder within 1 business day. Retail consumers should also have at least one option of payment per corridor to send and receive wholesale cross-border payments. So that's the ambition, but progress since then has been quite slow. According to data from the Financial Stability Board, the FSB, only 35% of global cross-border retail payments and 55% of wholesale and remittance payments actually settled within 1 hour of being initiated. That's well short of the target of 75%. Sub-Saharan economies, on the other hand, they're the slowest region in getting wholesale cross-border payments done. But ironically, they're also the fastest region in getting remittances sorted, even though costs are still quite high. So then, Wohoro Ndohho is the African director at Modernizing, a privately held company that provides payment processing software to 23 central banks on the continent. When we spoke this afternoon, I asked him why it's still so challenging in 2025 to have legacy systems in banks, mobile money companies and crypto systems seamlessly talking to each other across borders.
It's very difficult as they currently stand. And I think increasingly for them, and I know we'll be talking about this, the need to have the great sophistication of the systems of even the commercial sector has necessitated the central banks to also up their game. Mm-hmm. And so between also things like international debt, participating in trade globally, not just locally, mm-hmm. Has forced, in fact, all these countries to begin, one, to modernize their systems, but secondly, to begin to anticipate that day where it's, as we are seeing already now in East African region, a much freer flow of financial resources. Trade fast, and then people quickly find out that you can't have trade if you're not interoperable in terms of how it moves.
And I know there's many people who will be watching this, especially our viewers on the continent, who will be asking themselves, why is it in 2025 that individuals in Nigeria, in Kenya, can buy stocks in the United States, but we still find it quite difficult to move money, to make payments within the continent? Moving money from the west to the east and north to the south is still quite difficult.
It is.
Why?
It's a whole lack of a unified financial system. I think to a large extent, protectionism. I mentioned the difference in the sophistication of countries. Mm-hmm. The ones that have evolved faster have found it easier. But what you say true for money exchange is true for trade. It's been true for travel. It's not very long ago, you had to connect in Europe to get to West Africa. Mm-hmm. So the fact that when Kenya Airways opened a direct flight to Nigeria, I think it was a bigger deal than when they got on to New York. Mm-hmm. For the simple reason that that was unheard of a few years ago. Mm-hmm. But because of internationalization, also the fact that the World Bank, IMF, and those international systems have increasingly laid the law in terms of what is acceptable in terms of good financial management, mm-hmm. and public finance, and that has forced a good number of countries against their will really to sharpen their systems, evolve them. In some instances, actually, they've been financed to begin a process of evolving and upgrading their financial oversight systems.
Would it be easier if we agree as African countries on a set of common standards and common systems, or make it easier for systems in one country, payment systems rather, in one country to talk to payment systems in another?
Oh, in a perfect world, and in fact that's where the African Free Trade Area is going. Mm. It's been forced, but I think it's been forced more by commercial realities and commercial necessities. That the moment you remove restrictions and let business do its thing, by definition it has caused the conversation about integration regionally to happen. Mm. The best part, I think, of what we are observing now is that the impetus and the drive for this change is inborn, is indigenous. Mm. It's not only been imposed, in the past it's been imposed by when Europe upgrades its regulations, it makes us very difficult to do business with Europe, so it forces us to change our regulation. And to some extent, even you can even argue that for some countries, even Kenya included, that sometimes even our regulation goes ahead of a private sector.
Two interesting initiatives, at least on a continental level, to try and make it easier for capital to move around. PAPS is one, the Pan-African Payment and Settlement Systems, and the African Exchanges Linkage Project as well, which in theory would make it easier now for someone who's got a CSD account, a depository account, if you will, in Johannesburg, to be able to buy stocks quite freely in Lagos or Cairo or Casablanca and so on and so forth. What needs to happen to make those two things a reality, to make them much more efficient?
Oh, I suppose one is, usually the easiest way is just regulation. If you make it a function of doing a business in an economy, it forces that. But the second part is what we're about as Montran. And it's about assisting countries to upgrade their platforms, the financial infrastructure, so that is possible, is able to happen. The other thing I've noticed is that the drive, and this has to be a regional and continental one, the moment you have like a baseline of common standards, then it becomes a platform upon which you can grow. Now, it puts us in an advantageous position that at this point in time, we as Montran already have a large pool of clients who are basically regulators. And being able to supply infrastructure, financial infrastructure, digital systems that can work, and increasingly part of the reason we're in Africa is to say we are not all at the same level in terms of affordability. So you find that a lot of financial systems that function in India and in Europe are fairly expensive because they're fairly monolithic. But if you're able, for example, to almost tokenize it, for lack of a better word, into modules that can address particular current or urgent weaknesses in a particular economy. You can only do that by being local. You can only do that by marshalling local talent.